And so much of what we're going to discuss today is around the rapid change in FX that is being driven by technology. And I'm very lucky to have the panel here. I'm going to introduce them, and they will tell you a little bit about what they do, and also share with you some of the things that have surprised them, you know, as we have looked at what's happening in the markets. What has blindsided you? What's really taken you by surprise? And so I'll start with Victor. Victor Lebreton is the founder and head of systematic trading for QuantHedge. In 2012, he developed electronic trading desk and advanced trading strategies, delivering short-term absolute return investment. His research is based on automation, news analysis, AIs, and predictive analytics combined with systematic and algorithmic trading processes applied to FX, FI, and commodities and futures. So, Victor.
Yeah, good afternoon. So QuantHedge is a prop shop. So we are about 5 traders. We are 8 people trading. We have 3 founders. We have 2 main desks. One desk is the main desk, is FX electronic trading, doing futures and also index commodities. And we have another desk which is on equity market, which is more traditional portfolio management. It's only we're managing only our pool of money from the funders. Typically, we have been struggling moving from the FX market to other kind of markets, such as futures market or index equity market. Our experience is on foreign exchange and systematic trading. So when I say systematic trading, it means it's automated, it's algorithmic execution, and typically it's liquid situation in the market, liquid products, liquid assets. So we only went to the most liquid pairs in FX, so G10. We are mostly doing mainly futures commodities, the most liquid ones, gold, copper, and so on. Same for the indexes. So we were quite surprised in the market. First, when we started trading, where there was a crisis time, we started in 2009, 2010. There was a global equity crash in the market, as you know, and we had this kind of complete correlation of all the market going down same time. So that was the first, because all the models are usually doing mostly diverse, say equity rising, fixed income going down, and so on. So and it happens first time where we were really quite surprised, saying, well, we need to reassess the model. Then after the first, experience, we had some issue with the juniors guys. We all have juniors in our team, internships people. And they have good ideas sometimes. They do their own development, what we call that shadow IT, where they don't really understand what is a risk in the market. So we have one very clever and interesting guy working for Royal Bank of Canada as of today. He was doing very good algos, and he said, yeah, I just put all the algos same time in production and just see what happens. So what happens is that we lost 10%, and then the next day we won 15%. So the only issue he had a very good portfolio, but he didn't measure and distribute the risk through the algorithm. So all the algorithms were taking same risk in the market, like 200% of the book one day. So this is one of the big failure we had, that we're not able to monitor properly, junior people to make sure they understand the market in case of volatility or distribution of a portfolio. So you really have to check everything, my strong experience on that. Other issues is, spikes of volatility. We were there at the first flash crash, so we knew more or less since 2007 there is some, there was a quant crash with a fund from Goldman Sachs crashing, quite some $1 billion. So we knew they could have this kind of increasing peak and issues in the market in flash crashes. So we were really, really trying to avoid a situation where we could face a global exposure to a flash crash, so diversifying as much as possible.
Thank you. Graham Burnett is a hands-on CTO with a history of delivering global multi-venue cross-asset trading platforms for Deutsche Bank, for example. He is a pioneer in high-frequency trading engineering techniques, and he is currently the product director for security at Temenos, a leading supplier of banking software. He is a senior member of the Institute of Electrical and Electronic Engineers, a member of the Association of Computing Machinery and the Operational Research Society, and an external examiner for computer science and information technology at the University of Glasgow. I should have that memorized by now, but so please, Graham.
Hi, as I say, Graham Burnett. My background is in analog electronics, going back to the late 80s, which, although may not sound relevant, actually I think I'll bring it into the argument later on of where I think the actual trading industry is going. I started my sort of like career in computing in the military, basically writing large database systems, worked for Infomix, built the RAF sort of like database fleet, and then joined the city in 1996 at UBS, where I was in charge of the quant development team's development environment and built some of the sort of trading software there, introduced XML as a format over Corba into UBS, introduced Java over Delphi, so moved the organisation sort of like on, got quite involved in architecture and stuff like that, and then eventually left there and ended up in Deutsche Bank, where I built a very high frequency trading system for equities at the time, which was capable of doing 10,000 equity trades a second. It was quite innovative in the way it actually worked, because previously people would actually go to the order management system to get an order, and what I would do is basically give them a sort of like fake order and then immediately turn the trade round. So we were actually getting a lot more business through the gate than anyone else at that time. So eventually my software ran the smart order router and the internalization engine for Deutsche Bank for a period of 3 or 4 years before they moved it entirely to Java. All written in C, all written using specific techniques that basically ended up eventually applied a patent at Morgan Stanley several years later. I was also behind a thing called the Trade Ideas Monitor from a company called UDevise, who are now called the TIM Group. And that was really a way for equities research to monetize their research. Instead of having analysts making things up at the behest of the trading desk, we actually got them to do proper research and then provided a platform where they could get remunerated on it. And even had things like fantasy portfolios where we would build up things based on their recommendations and then use that to remunerate them at the end of the year. So quite innovative technology. My next phase was really moving into high-frequency trading, per se, with a small startup company who were called Slough Markets, and I built a global FX trading platform based in Slough, New York, all based on co-location, very high accuracy time, to the time that we were getting plus minus 2 micros globally, built on VPLS technology, all multicast, and we did make some money, but we didn't have enough money to basically make the platform successful, and unfortunately went out of business. Then I joined Morgan Stanley, worked in their Velocity high-frequency trading system, and then I went back into information security, which is really my background going back a long way. I've got a lot of background in cryptography, and I'm a bit of an expert on Bitcoin, having been part of the financial cryptography group, which started in 1999. And I know people like Ian Grigg and Zuko Wilcox, who are behind Hashcash, and Ben Laurie, who's behind RS Coin. So quite a diverse application development trading background, but also in financial cryptography.
And what surprised you the most? What has blindsided you?
And a thing I didn't mention, but I think I mentioned to lighten up the atmosphere a little bit. I used to work in the pornography industry, believe it or not. So we were in digital before, basically digital was actually what it is today. And my job was basically fraud analytics. So what blinded me was the amount of actual business that went through that sort of platform. We were number 2 on Streamline in the globally. We were 1 behind Tesco's. So really, those sort of like big data sort of challenges, because we had 250,000 customers online simultaneously, that's now becoming the sort of like norm for retail banks and basically digital sort of like delivery of digital services.
Saeed Amen is Managing Director and co-founder of Q Macro. He has a decade of experience creating and successfully running systematic trading models at Lehman Brothers and Nomura. Independently, he runs a systematic trading model with proprietary capital. He is the author of Trading Thalesians, What the Ancient World Can Teach Us About Trading Today.
Well, thanks for the introduction. Yes, I guess most of my background, as you mentioned, has been financial markets, particularly in FX. I think one thing that I've done over the years is now kind of move towards different data sets. So typically, I guess price data is the main data set that you'd look at for currency markets, and I guess most markets in general. But over the past few years, I guess since I left Nomura as an independent, I've started to look at things like news data and the like. But I've got to say, I didn't see that coming. I kind of more fell into it. So it's kind of just a nice coincidence that I kind of fell into that area, which seems to be burgeoning. In terms of things that I didn't see coming, I was at Lehman, and I didn't see that coming, for one thing. I thought something would happen, but I thought Lehman would get bailed out. And I guess in terms of this year, I guess both the Brexit vote and the Trump vote, I thought both of them would have gone the other way. But that being said, in these situations, you can still at least try and understand the event beforehand from a quantitative perspective. So in both instances, I did work with one of my friends, Ian Clark, who's an FX quant, and we tried to look at potential distribution of prices afterwards, depending on the options market. And actually, if you look at the options market before Brexit for sterling and the options market for Mexican peso before the Trump vote, the price moves afterwards actually did tally with the options market. So you'd have at least got an idea of potential ranges, at least, if you'd looked at the market beforehand. But I don't know whether it would have necessarily told you who would have won. So.
Thank you. Donald Byrne is the CEO of Corvil. He has over 25 years' experience working in the field of high-performance computer systems, network communications, and real-time data analytics. He joined Corvil in 2000 as the non-executive chairman, and since 2002, he has served as CEO, driving the company to a leading position in the world of IT data analytics and real-time operational intelligence. His most recent interests are in frictionless business models, economics of web-scale IT infrastructure, predictive analytics, the microbiome, Bitcoin, lean development, and the psychology of motivation.
Yes, I feel I have to explain the microbiome. If I was to start over my career again, I would be a microbiologist, because I think that's probably the most exciting technology that exists out there. But with that said, I'm stuck with fintech for the moment. So let me tell you real quickly about Corvil. So over the last 10 years, I think we've been in a somewhat of a privileged position, because we got a front row seat as the world's capital markets decide to hand over all of its trading to machines to do its bidding on its behalf. And the way I describe what we do is we're the other machine that watches those machines to make sure that they don't screw up. Not sure we're winning that war quite at the moment, because we're trying to figure out how to tell time, but that's a slightly different issue. So if you look at what we do, so we sell a platform. It's an analytics platform that examines all machine action down to the nanosecond, and probably going picos pretty soon, so that we can precisely tell every single action that a machine takes and then make sense of it, such that when an order is routed someplace and it actually achieves execution, you can reconcile that behavior and the fact that it happened the way you expected, and to be able to tell your clients that this is what has happened. And this is the whole world of how do you still maintain sight in an otherwise blind world when everything goes so fast you cannot see what's happening. And that's what we do. I will tell you, so three surprising things real fast. Sorry, pardon the pun. That firstly, I would not have thought that I'd be sitting here in the world of financial markets when we started out Corvil, because we didn't set out to solve this problem. This problem came and found us. And it was that we had developed very, very short timescale technology to be able to examine what electronic machines were doing. And so when we started the company, it was normal for people to observe what was going on in networks at roughly 5-minute to 1-minute timescales. And we came up with the bright idea that that's baloney, because there are queuing effects and there are other effects happening at much shorter timescales. And we said we're going to go for 50 milliseconds. And everyone thought we were bat nuts crazy. What are you talking about, 50 milliseconds? So we then showed up at electronic trading, and everybody goes, 50 milliseconds is way too much. You have to be at least at 10 milliseconds. And I would tell you, that was 2005. And we're now at 1 nanosecond resolution in everything that we're doing, and there's no end in sight. And so that it's not surprised that there's no end in sight, because if you follow Ethernet, I mean, no one would have thought that we're at 100 gig, but I will tell you 1 tera is not out of the question. There's just no reason why the technology will stop. It's only a question of, is there enough profit to go around? The second thing I will highlight to you, particularly in relation to this particular conversation, where the thing that really happened to us that was very negative, and quite honestly, technology raised its ugly head and it handed our head back to us on a platter, and that was that never underestimate the challenge of analyzing outliers. So one thing I will tell you is that almost all technologies work pretty good on average, but that is nowhere good enough for this game. The most important thing is that your tech works for outliers that you can't even imagine, because the outliers are always more extreme and less frequent than you imagine, and the sensitivity of these systems to outlier events is massive. And so when someone describes a hot brand new technology and go, look how wonderful this is, and we can drive machines automatically or cars and whatnot, that's fine. But this is a different game. And I will tell you, like, one trade can change the world, and that can happen in less than a microsecond. So show me your artificial intelligence, your big data, your machine learning that handles that problem and doesn't cause a mess in its wake. And that's the big learning, is that we developed algorithms, we developed technology that we thought, like, we're solid in the lab. And we started to deploy them. And we basically had to take it back in and completely redesign it and redo it. And that's the message I would give here. Be careful when you're taking technologies from other industries and saying this will be fantastic for our world here, that it's a whole new world that you've got to test that to.
Thank you. So we're looking, essentially there's no argument that FX is becoming an electronic marketplace, right? I mean, there's no argument about that. That's the way it's moving. That's the way it's all going to go. And it's like other markets before it. I've seen the discussion over how close it is to fixed income as well, how that is translating. But are there, as you're looking at other markets that have made this transition first, are there any lessons to be learned? Is anyone learning any lessons? Or what is it that makes FX unique to some extent? And also, if there's any questions, please feel free to put your hands up. I'm happy to take questions at any time. Yeah, anyone who wanted to answer. Is there anything that makes FX unique and doesn't translate to other markets, or are there lessons to learn?
I'll give a quick perspective just from a technology infrastructure, and then the guys will have much more detailed information. But I would tell you, our business last year, FX was our fastest growing business in terms of monitoring FX infrastructure. I would say to you that the nature of the problem, there's a lot of similarities. So if you look at, so for example, like equities, my feeling is that it took maybe a good 5-6 years for it to really mature. But FX is doing it in maybe 2 years. But the challenge with FX is a much more distributed market. It's not that you can simply go colo to one market, run a strategy and whatnot. It's much more distributed. The nature of how the tech works is quite different. Speed still matters, but it's on a global scale. And so quite honestly, the opportunity to either arbitrage or use technology to weight the decision in your favor is much wider. The other thing I will say is that in general, the FX community is less sophisticated, although that is changing from a tech adoption point of view. And it's also, there's a little bit of the Wild West in there in terms of it's not as tightly controlled. That would be my observation.
My observation is that people say the arms race has been won and no one's actually sort of like trying to get things to go quicker, and that's just not the case in my experience. The state of the art is FPGA-based trading, and there's several examples of that. There's Mercury Minerva.
Does everyone know what FPGA is? Does anyone in the room know FPGA, what that refers to?
Let me give you a quick explanation. It actually stands for Field Programmable gate array. So essentially, it's a configurable computer that you can actually program in the field, hence the field bit. It's used for spacecraft because spacecraft can get single event upsets that can basically blow a hole in the fabric, and you have to then relocate the whole chip somewhere else, reprogram it because you can't bring it back. So it's actually quite an old technology. The benefit of it is instead of doing a series of simple instructions, you can actually build an electronic circuit that does the calculation, and it's like basically switching a light switch on. Immediately electricity flows. There's no commutation. It's very, very fast. The downside is it's extremely difficult to program and always has been. And the issue is not in the actual program itself, it's actually the verification of the implementation. Hence, there's quite a large barrier, usually several years, to sort of adoption. But that hasn't stopped certain companies basically using tools like Python-based MyHTL to write training strategies there, for other people to use other synthesis languages to put training strategies on FPGA. That trend is accelerating. The interim period has saw a lot of people use the instruction sets like SSE, AVX, to actually sort of like accelerate their programs on the actual Intel chipset. But really, I see it's going still down onto the hardware, and I see that's only going to get more interesting as Intel and Altera bring out their new co-hosted chipsets with very fast interconnects and the OpenCL implementation of their language.
What does that mean for how does that actually change FX trading? And the result is?
So what it basically does is when you're receiving a packet, actually as it's coming off the wire, you're actually constructing the trade instruction going out at the same time. And it's when you see the price, you can then flip the price on the outgoing packet at the last second. That means that there's almost no latency on the turnaround of a trade on a very simple strategy. So that's what it means. And people are, as I say, people have been going into assembler for the last couple of years, and it's only going to accelerate, I think.
I sort of feel like we're moving into the present. Did you want to say anything about lessons learned around FX markets?
Well, I think the lessons learned around FX markets is that it depends upon if events are expected or not. For example, you had the SMB, that was an unexpected event. And then it was very difficult for the market to react and to provide liquidity around there. But I think one of the lessons learned from that is when there is an expectation of a dislocation in the market, let's say over the evening of the Brexit vote, people were trying to be very, very well prepared. And actually, you did see the FX market coping with that. So I think people have learned lessons, for example, from SMB and other instances. So if there are things that you can prepare for, they are preparing for that. So.
Yeah, my vision would be more on there is a structural change from the past, and we can learn from that. So if you remember the first, electronic trading, FX, more institutional, people on the phone talking computer, Bloomberg. Then you got to retail investment, internet in the late 90s, beginning 20,000. Then we got the algorithmic execution from equity coming in, changing completely the market of FX brokerage, moving global, really institutional plus retail. And now we see all the digital stuff coming in. So I think we have a gap each time. There is a complete change of the technology, the way of distributing the quotes, the service, the quality, the liquidity. And from the past, I think we see exactly this kind of things arriving now. As a new situation, and there will be a redistribution on the FX space globally. Also, we can think about digital currency already there, and so on. So, I don't know exactly where it's gonna go because I'm not can no do prophecy here, but typically, as that's what my experience from the past, that we see a major change in the global FX market on the technology side, where most of the guys moving from also to the cloud directly. Try to be rid of for light tech or heavy technology demands and just move into cloud environment. We see that much more on technology guys sitting there outside.
And that does bring us into the present, which is kind of what's happening right now. And who is making money? Like, who is set to make money? Who are the winners and losers in this reality? And where is the investment in technology going right now? Because there are a lot of buzzwords, and some of them like cloud or FPGA or AI or machine learning and these things. But what does that actually look like in terms of who's investing and how much?
Well, I guess one way to look at it is also that with new technology, the barriers to entry are a lot lower. So, for example, if you look at Python, It's a lot easier now to create a trading strategy and to back test that and to run that now than it was, say, 10 years ago. There's so many tools which are free and open source for that. I'm not talking, that's not necessarily trying to do super high frequency, but saying the barriers to entry for doing lower frequency trading in FX from a quantitative perspective are a lot lower. So, for example, if you are a retail trader, you can actually back test your trading strategies now without too much difficulty compared to the past. So maybe the fact is that you don't need as much investment to get the same results now as you used to.
But from our observation of working with a lot of the FX customers, it's not unlike equities. I mean, it's not. Most of them don't per se have high frequency strategies like that, but all of them deal with the challenges of advertising stale quotes out to their clients, and that's become a real problem. That their clients are saying, look, I responded to what you sent out to me, but I just didn't get my price. And that is a latency speed problem, irrespective of strategy. And what people are finding is the same thing they found out in equities and they will find out in fixed income and whatnot. That is that prices move and move quickly. And it's a dynamic situation and they're just moving more quickly. And if you can't keep up with that, you will not be successful in your FX trading strategies. And so people are now investing, and there's no question that cloud infrastructure and those type of technologies will play a role. But right now, the people who are investing are just saying, look, I cannot be operating off of stale quotes.
And one of the observations I've seen is that, the real bottleneck and problem here is actually exchange technology, some of which is based on Java, some of which has basically garbage collection, sort of freeze the world events. And they're trying to augment this by putting, devices that deliver data at 40 gig a second. There's the New York Stock Exchange released a full market depth feed that has that sort of level of information. So they're trying to do band-aids onto the sort of existing technology, because if you look at Eurex, which was recently rebuilt, they actually sort of allowed you to see the timings of the individual elements of the exchange operation. So people had a much greater idea of what the inbuilt latencies in the exchange were, rather than have to send fake trades to actually time the trade route, which was quite common. So I see that as, I say, when we talk about the future side, we'll talk a little bit more about that.
I would say on the present side is what we see is the game is really still a technology game. We were talking this morning also microwave. So if you got microwave, you're faster. If you got cloud and large big data services, and it's bigger for you. You got better information on the market. So there is still a very very strong technology race to be faster and better and aggregate flows better than the other. Also edge yourself, leave the market faster. Don't be directly exposed to the market. So the technology is helping you today to do all this. My main concern is that for now it's only I would say FX, but it's more global, but it can spread to much more other products on FX, such as NDF, swaps, and so on. And we start to see more institutional product arriving in the retail market, saying now with technology we can distribute it. So it's today. I don't know about the future for now, but today we see all this change. And and as if you start retail trader, you say, yeah, why not going into a swap or whatever if it has this kind of like ETF-like solution, and you just trade just with your mobile phone, it's okay. Just don't need the institutional infrastructure to trade.
Graham, I know one of the things you said was it's killing the smaller player right now, like the huge amounts of investment necessary. I don't know, like that's a little bit against what Saeed had said about, well, it's cheaper now as well.
I don't really think it is cheaper, because the biggest cost is people, and people with the right expertise. And I'll give you an example of that. CME have a new feed, which is basically an ASN1, Abstract Interpretation 1. It's a highly compressed format used by the telco industry, but it's now been used to deliver market data. And someone has developed a feed in a language called Lua JIT. Now, this is an unheard of language in the marketplace. I've only ever seen it used in two places, which is in network analytics and communication, but also in trading. So they've got this very high performance technology that's based out of the CPU registers. They're now using it for basically parsing market data. It's yet another augmentation of the existing infrastructure to give speed advantage to people who are there first to implement the solution for that. So really, I think, as I say, the biggest impingement on the small player is cost of people rather than infrastructure.
And one thing we haven't mentioned is regulation as a driver of technology. I would say, Alex, so like on a scale of 1 to 10, how much do you think regulation is driving technology?
Well, the other surprise that I had, the thing that I thought was never going to happen was MiFID II RTS 25. Subsection 3.2. So for anyone who does, everyone knows MiFID II. Maybe some know RTS 25, but the key regulation there was that MiFID II, for certain types of algorithmic trades that meet certain criteria around where they're traded for gateway response times, requires you to synchronize all of your business clocks to within 100 microseconds of UTC. And that's maybe gobbledygook to most everyone, but I really didn't think that they would go and do that. I actually think, unfortunately, it's a midway answer. It's not. It's much more granular than you would think, and it's not as granular as it actually needs to be. But with that said, I never thought that was going to happen. Now, to answer your question, Anna, that in its own right has sent most people into panic to say, how on earth are we going to meet that regulation? What does it mean? Are we going to have to just redo our complete software stacks? How are we going to make sure that that's implemented? And how are they going to use that data to detect market abuse? And what happens if they come calling? Do I have the forensics in place to say that your data is wrong, my data is right? And this is now, this among other things is really reshaping the whole tech stack, the whole technology data stack, because of that one thing. And so I absolutely believe that certain regulations have a major, major impact on both tech choices, but also budget. Basically, where are they going to apply their budgets?
Totally agree with you. Yeah, I think the drive towards hierarchy time has been something that's been coming for a long time and definitely necessary. I mean, there are technological offerings out there from National Physics Laboratory and NIST, but they're by no means cheap. And it's not the fact that you've got hierarchy time that's important, it's how do you analyze, how do you do the post-trade analytics? That's the thing that's going to kill you. So you have to basically have everything, and it has to be in some way protected from modification. So there's huge cost implications there.
Yeah, maybe on the regulation side also you have the validation of the algorithms. It's not only time stamping, but it's also the fact that the algorithm is not harming the market directly. So how do you backtest your algorithm on the regulatory side to make sure it's not harming the market? Yeah, let's say it passed the test and then the market crashed and the algo crashed. What is the regulatory doing? Say I've regulated an algorithm that has crashed the market. So it definitely not the regulator who would do that, but an expert company saying, I guarantee that this algorithm is third-party confirmation, And
Right. I was just going to bring up the flash crash trader, Sarao, actually, when you were saying that. I mean, he's just recently pled guilty, I think.
Yeah, but see, the situation is so much more worse than that.
Okay.
Here's the crazy thing about trading in this machine world is we actually can't tell time. So the equivalent, so let's say MiFID II gets its way and everyone thinks it's crazy stringent. And let's say we synchronize all business clocks to 100 microsecond, and let's say that all goes famously, which I guarantee you it won't, because those technologies are not that robust. Even if we used, the National Physics Lab, and that's not the hard part. The hard part is actually getting the data accurate. So let's say that all works swimmingly, and we have now data accurate to 100 milliseconds. or sorry, 100 microseconds. So with Graham's FPGAs and what they're doing, how fast can we make a decision and make a trade? Well, it's sub 1 microsecond, right? So FCA gets its data, and it says that trade caused the new flash crash, wiped out FX markets overnight, like mayhem, total mayhem, makes Donald Trump look like a small issue. Then we go in and they go, yeah, but any one of those 100 trades could have caused that. We can't tell A from B to C as to what caused what and who was to blame, but yet you're going to be called up in front of a judge and jury with bad data because we can't tell time. And to put it in perspective that you can understand, because this is it all happens because humans tell time in human time, and we understand time from a human perspective. Machines can act between 100,000 and 1 million times faster. So it would be like you wearing a watch, and the only thing that the watch could tell you is the day. It can't tell you the hour, it can't tell you the second. You couldn't tell whether you had breakfast first or dinner first. You couldn't tell whether you came home from work first or you went to work first. You cannot tell. And so the issue here is not speed, it's time. And if you can't tell time in machine time, you can't run orderly markets. And that is the situation that, quite honestly, our politicians, our regulators, and our industry doesn't want to grapple with. Sorry, that's me done.
Yep. Let's talk about what gets you excited about future developments. Like, what are you really looking forward to? We have about 5 minutes. Again, I'm happy to take any questions if anyone has any. But what is it about the future where you're like, we're really looking forward to that? You know?
Well, I was going to say I'm really looking forward to lunch, but lunch has already happened. So I think one thing that I'm looking forward to is something that's already started just in terms of looking at alternative data sets. You already started to see that, for example, in news data and the like, but there's so much data being collected, for example, on the web, through our mobile phones, through everything, like the Internet of Things, that I think there's lots of potential there for that to be used to understand markets better and to make better trading decisions. But the key issue here is there's so much data. It's a question of understanding which data sets are actually useful. So that's the big challenge I see going forward. So I'm hopefully going to be part of that, but we'll see.
Well, futures for me is more digital currency, private pools of liquidity where you keep the liquidity for, friends. You would have also a lot of artificial intelligence model, but more autonomous, saying if we need to tell who's guilty of something, it may be a model, it may be an artificial intelligence model, owned by a company, but no one really will be responsible unless the model. Like when you drive a car or when self-driving car, who's responsible for a failure or an accident? So you will have to a specific set of laws to tell people and to tell algos if it's responsible personal, it's a company, it's a technology failure. And many lawyers start to have a look at that also on the financial market. This is a bad world we're going.
I'm not sure if this is something I'm per se looking forward to, but I do think that this is the next thing that, we talked about FX markets. Right now, FX markets are struggling to catch up from a speed point of view, but there's already a whole new game in town. And that we refer to this as intelligence about speed. And so our view is that intelligence about speed is going to be more valuable than speed itself. And if you're not on that wave, you're already way behind. And what I mean by that is that already we have marketplaces who exist based on an anti-speed principle. So they may be putting in maybe putting in
ParFX, right, has like a
ParFX, yeah. So I like the guys at ParFX, and they're juggling everything up largely to obfuscate. So if you have a particular high-speed strategy that says I can jump in ahead, then that will obfuscate. It doesn't eliminate; it just obfuscates. And so if you're a clever mathematician, you'll go, that's just a puzzle. It's just a puzzle, and it's another speed dynamic. And we live in a world where there are multiple trading opportunities in multiple places across the world. And so the people who have the best information and the best analytics to take advantage of that will win. And it doesn't matter whether you're fast, slow, indifferent, random, predictable, the math, the data, and the visibility, if that's there, you will gain advantage. And so I say it again, that it's going to be intelligence about speed will be more valuable than speed itself.
I see predict the rise of the analog exchange. I use in analog electronics, which is far more powerful than potentially message passing, which is what we do today. I also see new transmission mediums. They're already talking about RF to be used for global communications, and I think that's going to be something that's going to be a rise over the next year. RF, by the way, can transit the whole globe at the speed of light, and it's a limited bandwidth, but it is another channel that potentially we could use.
Okay, gentlemen, we've run out of time. Thank you very much. Are there any questions? But I could, please, yeah.
I'll just push out. Do any of you have any experience in pattern recognition systems, or do you have any insight on how they might be performing?
Packet recognition.
Pattern?
Yeah. Pattern recognition.
Pattern recognition systems and how they're performing.
Data scientist here.
So I have a couple of, my chief scientist is well, we do both packet recognition as a matter of course, because we grab all of our data from the network. The pattern recognition stuff, we've been looking at that from a point of view of identifying behaviors and anomalies within, I would say, trading behavior. So here's the challenge we see, is that we feel that those technologies are right 95, 98% of the time, but getting them to 99.999% of the time, which seems to be the level at which people are comfortable at, is hard, it's tough. And I think that the predictive technologies and whatnot is about narrowing that gap. And I think there's a lot of really encouraging work going on there, and it will undoubtedly get better and better, but there's still a long way to go in my estimation.
There is quite a lot of work on what's called temporal cube analysis in the intelligence sphere, where they're looking at basically the correlation and signature of events and seeing basically if they can actually sort of like replay a history and recognize an event that's about to happen again. Quite how successful that is still in progress at the moment, but that's an area of research.
Okay, I bet there are more than a few questions, but I highly recommend you actually approach our speakers. I'm sure they'll be around for a little while, so please do, but I should wrap her up. And thank you please join me in thanking our panelists.
Thank you.